Good morning, folks. Welcome back. Happy Friday. We made it. We're at the end of the week. Markets have pretty much jumped continuously. I mean, if we look at the NASDAQ a week ago, we're up about 4%, around there. So there's definitely a lot of optimism teeming in the market and the economy as well. Um, Not much more to say before we jump into the model portfolio, other than the fact that this entire year has been a process of me realizing that this recession is starting to map out as what the industry has called to be a soft landing. We've talked about this before, and it's the notion of the Federal Reserve being able to squash inflation without sending the economy into a full blown recession, into an economic contraction. We certainly saw an economic slowdown over the past year plus around there, especially following that post COVID vibe where everyone was buying up stocks, everyone was buying up technology stocks. The thesis of work from home forever, the thesis of, technology being the main utility in this new sort of world and life that we're living. The entrance of new players into the market. You have OpenAI, you have things like TikTok over the past few years. It's been a really insane cycle coming off of a global crisis into a massive recovery. It goes to show that the U.S. remains kind of the most attractive market to be in. Investors all over the world want to buy dollars, to buy U.S. assets, regardless of how dark and bleak things get. And for now, that remains. Will that change? Maybe in the very long term, if the quality of our companies change, if we can no longer innovate, if we can no longer be creative. But for now, it looks like Jerome Powell has really walked the tightrope between, the two tallest buildings of the world in getting us through a recession while avoiding a hyperinflationary scenario. We've talked about it ad nauseum. If you guys are still awake, let's just jump right into the model portfolio that we built. So for those of you that aren't familiar, this model portfolio, let me see if I can make the whole screen visible for you guys. Sorry about that. As long as we give you the corner here. But the point is like this model portfolio was built under a couple of different assumptions. And some of you have read the write-up that we have on Substack justifying the majority of these picks. And the only change I've made to that Substack article was the addition of Facebook in February to the bet here. Just trying to make this just right for y'all. Okay, perfect. So this is the model portfolio. As you can see, it's got a very nice slope. We've done very well this year. But it was built around a completely different set of assumptions. So here at Guardian, we're focused on building wealth for the next generation, be it millennials, older, younger, Gen Z, or anyone really that's coming into that position where, it's my responsibility to make these long-term investment decisions. It's my responsibility to be knowledgeable on my own wealth and on what my future plans are and how can I get there. And so this portfolio was kind of built around that type of customer. Someone who's maybe starting, has a lot of time to invest, wants to buy high quality assets based on, a series of convictions about the future, about industries, about technology, taking very much kind of a top-down approach, not trying to be in the weeds and find that one biotech company that's going to 100x. That's not what we do here, and I frankly don't believe in that unless you are spending 100% of your time trying to sort of exploit or discover some sort of arbitrage opportunity, some sort of risk opportunity that the market doesn't understand. And that's what hedge funds are, right? Like a hedge fund is, hey, we focus on buying tech companies that have bad capital structures, but we can do the work to find these companies, figure out which one of them are actually going to fix up their situation. So we bet on those companies, and we expect to make a 50% return, 100% return on investment. That's what a hedge fund does. They're very specialized. They're looking for one situation or one type of dynamic to exploit and beat the market. What this model portfolio is about is pretty much let's try to beat the market in a less concentrated way. Let's diversify a little bit let's still allocate quite aggressively, meaning like we don't have 100 names on the portfolio, we have 10 or so. So it's still very concentrated, which implies a degree of like conviction and aggression. So this is definitely not, your super safe 3% a year, 5% a year portfolio. It has a ton of risk. It has, I like to fancy myself a factor-based investor. I'm not sure if I'm the ultra quant nerd that I used to be to call it like a pure factor-based. And what that means is, you can run reports on your portfolio and using these proprietary models built by people in the risk management world, people in the financial modeling world, that tell you what each investment is exposed to. So, for example, a company like Apple, one of the largest factors that it's exposed to is interest rate changes. So, you could have a portfolio of 10 different stocks that are totally different, but then you'll run like a factor analysis, and then you'll be like, oh, 3/4 of our portfolio is exposed to the same stuff, even though one is Apple and the other is a fintech. They behaviorally will perform similarly because they are sensitive to the same factors out there in the market. And it's just a really good way, I think, to analyze a portfolio that you've built kind of from the bottom up, run it through some factor analysis, identify the commonalities, try to like hedge out those factors or nullify some of the risk, or maybe diversify more into names that have different exposures. But I digress. Here it is, right? We've done quite well, but you always need a benchmark when you're kind of comparing yourself to the rest of the market. It's sort of meaningless to say, oh, my portfolio is up 100%, because if the benchmark's up 100%, well, you're not that bright. And if your expectation was to be up 20% and you're up 100%, good for you, but you were also wrong. I mean, there was something you missed in that picture. And of course, if you're below the market, then maybe it's time to just buy the index and sit down and reconsider and go back to the drawing board. But here it is, and the idea of this small portfolio, and I can go into the allocation in a second, meaning like the distribution of investment. The idea was to have a pretty aggressive, fairly diversified portfolio with exposure to a few different sectors, primarily energy and technology, with light exposure to international. So we have Japan, we have Europe through that DTH ETF that you can see. If I go here to my thing, you can see DTH. This is a European high dividend business ETF. And then we have things that are sort of non-correlated or less correlated, like Bitcoin. And we have India as well in there. So there is international exposure. A lot of these businesses have international exposure. FCX, one of them, the mining company. And like I said, we have XOM Energy, FCX, Commodities, Metals. Nintendo International, Penn Gaming is entertainment and gambling, gaming. UST, Treasury bonds, we have some other assets, asset exposure. This is a multi-asset portfolio, so we want exposure to other assets other than equities. Why? Back to that factor logic, where if all of our companies, all of our investments are U.S. equities, we're massively exposed to U.S. equity risk. So, you could be right about a lot of the companies, but if there's some sort of macro shift that takes place, all of your companies will sort of correlate under that risk exposure event. Then we have Uber, U.S. tech, but more of a service than say social media or something along those lines. It's not like an ad revenue business. It's a brick and mortar. We sell you service. You pay us a subscription or a fee. They've done fantastically well, and that was one that we kind of took a beating on when we were building the thesis to invest in. So I'm pretty proud of Uber. Meta, another one, we added it late, to the model portfolio. We added it in February. Would have done better if we had it from the beginning of the year, but it's been, the marquee outperformer in the model portfolio. Bitcoin as well, and I felt hesitant when adding this to the model portfolio because I declared that we would have an equal weight investment. So in theory, this model portfolio every allocation, so every name that we bought is equally weighted. So it's 10% Nintendo, 10% Pen, 10% USD, 10% India. It's not, like for example, the NASDAQ where a lot of the concentration is only in a few companies at the top. We've decided to do an equally weighted distribution, and that's not better or worse. It's simply an approach. A lot of the indexes and ETFs and products that basket up, various companies under one product, they tend to use a lot of market-weighted processes. So what they'll do is like, okay, we have this ETF, it has 50 US tech stocks, and we weigh them by market cap. So the largest company gets the most investment. A lot of things are built that way. It makes a lot of sense in some respect, but it's ultimately a risk management decision on a personal level. So I decided to build something pretty diversified, pretty aggressive, kind of a nice, medium aggressive, diversified, concentrated portfolio that I think most people within our age group, within kind of our trajectories of our life plans, could definitely buy into. And I bought this, or I built this rather, because it's a model portfolio strictly governed, with the intention pretty much of losing money for the most of the year. And that tells me two things. One, my top-down view was a little bit incorrect for the duration of the year. We're only halfway, so I'm scaling back some of my conviction from the top-down view, but I'm certainly retaining a big chunk of it. Bottom up, I think we did a great job picking specific companies within their sectors for a variety of reasons. So, Meta is another one that I'm pretty proud of, because for the last 2 years, I've had some conversations with one client, another friend, over and over and over again after every earnings report, being like, this company is undervalued, it's going to explode once they kind of get their house in order, and sort of clean up, and that's what Meta did over the last year. They fired a ton of people, they restructured, they pivoted their focus, they're launching new products, they're testing things. So Meta has been a fundamentalist win. It was a company that we kept looking at the financials and being like, why is it being so punished for how strong it is? And so that's one that we are quite proud of. Similar case with Uber. In the case of Uber, it was more like this company is unbelievably resilient, especially right off of COVID. And it was a great sort of performer of an expensive tech company, but still that was trading at a discount previously. Bitcoin felt like a no-brainer. I mean, it was kind of cheap. The regulatory and legislative track was fighting against every other cryptocurrency and every crypto business around Bitcoin, but leaving Bitcoin alone. So that was largely the thesis here. I'm a believer in kind of Web3, blockchain, and all those technologies. I still think we're in extremely early stages, and most of the companies that exist today surrounding this technology will likely be gone in the next 10 years or so. So that's why I was comfortable with it, liked it, I still like it. I want some exposure to this wild, wild west world, and every day it's something new with the ETFs. So we're getting a lot of traditional finance firms, asset managers, getting very curious, registering products, asking the SEC for permission. So this is something I like, and I think it's an asset class that you can own, have exposure to the space. You don't have to be like on Twitter every waking moment, updating every, project or level 2 currency or intermediary token, blah, blah, blah. You just buy Bitcoin. I like the industry. I like the roadmap. Let's just sort of buy it. And that's going back to that view, how I had the top-down view a little bit wrong. The intention of the portfolio was, hey, I think that this year might be tough for U.S. equities, particularly technology. We are young. We're a community trying to sort of buy in, establish good decision-making frameworks to grow well. These are all high-quality companies that I think have enormous standing power, value, brand management teams. Of course, the ETFs can't speak to that, but they were exposures that I wanted for the very, very long term. And every name on this board is something that I would be willing to buy, even if it's losing value. And so that was my view for the years. There's a lot of sort of potential. There's a lot of unknown this year. There may be some more volatility. There may be a recession and an economic contraction. Interest rates are going up. That's going to continuously put pressure on tech, even coming off of last year that was so abysmal. So I built this portfolio with the intention of, I want this to be something that people would be like, I will continuously buy this as the market goes down, as that economic pressure, inflation pressure weighs on these companies, because I'll be buying into some really high quality stuff at a discount that I missed. I mean, a lot of us missed it, right? Especially if you're in your 30s, etc. You know, we didn't have the surmassed amount of capital to aggressively buy into the companies that have done so unbelievably well over the last decade, 2 decades. And so frankly, anytime there's been a massive index level correction, the NASDAQ is down 20%, or the S&P as well, I get a little excited because it's like I can buy into some high quality stuff at a price that I didn't necessarily think I would get to see again. So it sort of worked out. Our bottom-up process was excellent. Our top-down process was consensus, right? Everyone thought a recession was coming. But we seem to have kind of gotten it wrong for the first half of the year. The beauty of it is we sort of got into this early enough. We came to this conclusion early enough. You can never go wrong buying, very, very financially sound, high-quality businesses. And we were rewarded for at least part of our philosophy in building this portfolio. So it's been great. I haven't updated it since last month. I'll update it at the end of this month as well. But I don't want to pop in too much drive to show you guys. But overall, the last update we did, this portfolio is beating beating the S&P by between 11 and 15%. We have to check, but we're beating our benchmark. Our S&P is our benchmark. We'll probably build a custom benchmark going out because the S&P doesn't have international companies. But because we have energy, because we have banking and tech, and then these ETFs and some specific names, we felt that the S&P was a better benchmark to use than the NASDAQ. The NASDAQ is up, 42% year to date, so it has been a fantastic year. Our portfolio's, trailing the pure NASDAQ, but I think given the risk profile, the fact that we have fixed income in the portfolio, the fact that we have financial firms, we have dividend yielding firms, we have European exposure, Japanese exposure. I'm pretty proud of that performance, and beating S&P is not an easy feat. There are people who have entire careers, and the best they've done is beat the S&P by, a couple of percentage points ever. So we're pretty proud of this. And with that said, I want to get into the advanced view that we have here. Hopefully, I still have all this up. Okay, so this has been great. So TradingView is pretty cool. That's the app the web app I'm using. They're very good. Excellent pricing, very fast. Lots of features, cool integrations, but here they attempt to kind of break down the portfolio into sort of an asset allocation, but to be clear, it doesn't do a good job of looking through and saying, the UST allocation, which is U.S. Treasuries, is fixed income. It doesn't really tell us that, so this isn't the best asset allocation breakdown, but it does tell you a little bit of where our exposure is. So about 22%, almost a quarter of the portfolio, is in technology services. Another 22% is in financial services. There's the JPMs and the BlackRocks that we have in there. Transportation, 11%. Uber, electronic technology. I'm going to have to parse that one out between the tech firms and what we have. Consumer services, energy and materials, non-energy materials. And so, like I said before, we're looking to do an equal weighted portfolio with this. And by name, it's equal weighted, but as you see, we have a skew towards tech, and we can even add this. So you could call it almost a third technology, 33% technology, and then another large block in finance. So 50% of the portfolio, pretty much, 55% is in 57 is in technology and finance. Those were two segments, especially if we find the intersection of the two. FinTech was one of the most punished subsectors in 2022. So, it was sort of a good buy. They haven't been our top performers. Let's take a quick peek. Oh, no, we're back on Bloomberg. We'll go back to this. They haven't been our top performers. So, Penn, which is one of my favorites, we got smoked. I mean, it was the worst pick in the portfolio, and I still like it. I'm going to go back to the drawing board, but I still like it. Penn Gaming, it's kind of Barstool Sports combined with this gambling company, Penn Gaming. BlackRock is only up 5%, trailing, the benchmarks, trailing the Nasdaq, trailing the S&P. Not great. JP Morgan a little bit better, up almost 6% this year. So that's done okay, but both of them have weighed. They've been actually a negative factor in the portfolio. So this has kind of stunted our growth a little bit, but I feel good. I feel very good about it, especially thinking longer term beyond this year, etc. Technology is the firecracker. It's where the return is going to come from, but it's also where the volatility can come from. All the other stuff is a little bit more humdrum. I was a little too bullish on commodities and energy at the beginning of the year. I think I'm still going to get my licks by the end of the year. Things are heating up, oil prices recovering quite a bit, etc. But it also has been a negative weight on the portfolio. So what has been the source of our return? The source of our return has been technology. It's been technology and consumer services and Bitcoin. Here they break down, try to do a little bit better in asset allocation. Of course, it's still imperfect because they're saying I have 21% in funds. It's true, I have ETFs, but is that really a fund? No, it's really equity. So let's call this 85% stock. And then this 7% is also a stock. So it's saying 85% stock, 7% crypto, and that leaves us with an excess. We'll call that excess fixed income for USD. And then depository receipt is just saying that because the Nintendo ticker is an ADR, so it's technically not a US stock. It's like a different synthetic thing that mimics the performance of the actual stock. So yeah, that's today's talk for the most part, guys. I mean, we went over the economy, we went over the model portfolio. I know I have a couple more promises here. Yeah, Japan versus China. You guys are probably bored of that at this point, though. But really, we'll dig into that next week because there's things are flowing out of China, business is flowing into Japan, and there's a whole historical backstory that also includes the U.S. So I'm actually going to bump us off of that. You guys have had enough. Have a great weekend. We'll catch up on Monday. Remember, Monday, Wednesday, Friday, 9 a.m. live through the Discord. Feel free to share with whoever you think would find it interesting. We live stream on YouTube, so you can also go and subscribe to the channel and set alerts. You might get it sooner than on the Discord. But in general, everything that we think is worthwhile is going to be sent to the Discord. All right, guys. Have a good weekend. Bye.